Jack, you focus more on the fixed income side, so let's start there. Do you think the 10-year yield is going below 2%? We're just a couple of ticks away from that.
Actually, I think it will. I don't see a lot of inflation pressures. We know the economy is slowing. The last part of the economy that was certainly holding up, the employment market is now certainly showing some signs of weakness. The market's offsides. We've got a lot of the leverage guys short. So, yeah, I think we are going to see it trade below 2, but I think most of the moves already happened. So, but we're still long treasuries.
So you think that's on a weakening economy, or what's the sort of fundamental rationale?
So I think it's actually the reason that we've liked treasuries for a while is because there hasn't been any inflation pressures. The secular disinflationary pressures have sort of won out versus the cyclical. We've had a strong dollar last year. It doesn't get a lot of talk, but that actually has been putting pressure on the U.S. economy. And then clearly the trade tensions are seeing CapEx getting pulled back. So it's a confluence of things getting us to wanting to own treasuries.
And I mean, Mark, if we have low inflation, then it doesn't really matter what happens to the economy, right? I mean, unless that suddenly starts accelerating. And yeah, we're going to have some tariffs, but a lot of those are one-offs. At least they look like that for now.
Well, and theoretically, the less inflation becomes a problem for the Federal Reserve to have to act. It ought to be able to help to underwrite further expansion than in this already rapidly approaching 10-year economy that's been growing positively now. And so I don't view that as necessarily the threat at the moment. I think in the context of the global concern, we haven't yet seen any turnaround relative to some of the stimulative measures taken by China to try to resuscitate economic activity there. So I think we've seen in the past that the U.S. Can mitigate some of the concerns around global activity, since only about 12% of GDP is export driven, but it can't necessarily be immunized from it because we are a participant in the global supply chain and we see that suffering at the moment. So I think that, to me, is what I'm monitoring more closely than what I think U.S. economic data is currently presenting, which I think is still a fairly decent case. This job number taken into account, of course, but one that in my mind doesn't necessarily pull the Fed into a rate cut, at least in this upcoming June meeting.